Right, welcome back to Business Today. We're still talking the issue of Finance Bill 2024 and how it impacts businesses in the country. And joining us is Keegan Kiplimo, who's the head of policy, the Kenya National Chamber of Commerce and Industry, and he joins us on our phone call. Thank you very much, Keegan, for staying with us. Now let's go to the areas that are not so rosy when it comes to Finance Bill 2024. I assume there are so many, but for starters, one of the biggest ones that we've seen, especially on public discourse, has been touching on the motor vehicle tax and the issue of bread, because this actually impacts on people eating or feeding and people moving in one way or the other. Talk to me about how this popular pointers first impact on the micro, small, and medium-sized enterprises in this country. All right, apologies for that. Keegan, I don't know whether you can get me from the other side? Okay. We seems to be having a little bit of a technical challenge in getting Keegan Kiplimo, who is actually the head of policy at Kenya National Chamber of Commerce and Industry, and this touches heavily on the issue of Finance Bill 2024. Remember, there are propositions within the Finance Bill that is impacting every facet of our lives. And now we are at the public participation stage, which is ongoing, which is very, very critical in this particular situation. But at this particular moment, I think we've gotten hold of Keegan. Keegan, I wanted us to touch on first of all, the popular discourse that we've had on the finance bill. And I know even as we discuss these popular things, just underlying, there's so many things that are being overlooked that will impact on business, on personal finance. But let's get rid on this popular issue, the issue of motor vehicle tax and the issue of taxation on transporting bread. How will this impact business, especially the micro and small businesses that dominate our business landscape?
Thank you. And the proposal on motor vehicle tax, which is 2.5% of the value of the motor vehicle, is one that has raised a lot of concerns in the private sector. And just to start with, the motor vehicle tax, the proposal is under income tax in the finance bill. And just looking at the technicality of it, it's not an income. A vehicle is not an income. It's not like pay, where you pay income tax under it, the monthly salary. Because now this being a motor vehicle is an asset. If anything, sometimes a liability for personal vehicles. So in terms of technicality, it does not qualify under motor vehicle, under income tax. Second is there is an ambiguity in the proposal, particularly on the question of it. It proposes that the tax is paid on the issuance of the insurance cover. But then the question here is, I have my members who are in the insurance sector, and they do give a monthly policy where at the end of the month, you can go and renew your insurance, get another 1 month insurance cover for your vehicle. And you have the annual motor vehicle policy that you renew every year. Now, the question is, for the monthly one, do you then pay the tax every month? That needs to be clarified. But then the question that we are also asking as the private sector is what are we addressing with this new tax? Because as it is, you pay tax when you're transferring ownership of when you're buying the vehicle, right? You're also paying taxes on the usage of the vehicle through the fuel that you use. And currently, you have around 76% of the tax on the landed cost of fuel. So it's 76%. The taxes that are applied on fuel is an equivalent of 76% of the landed cost of fuel at the port of Mombasa. And you have the 18% road levy, 18 shillings road levy that is charged on every liter of fuel that you consume. So then we have already a plethora of taxes that are being charged on cars and the usage of cars through fuel. So then why do we have this new tax? It's like you're somewhat criminalizing the ownership of vehicles. And just something to mention on that point as well is the insurance companies are going to become the tax collecting agents for the government in this case, because they're supposed to collect the taxes and remit within 5 working days. So this is going to place an administrative cost on these insurance companies, because they'll have to hire more people in their finance team to be able to collect these tax and remit these tax. And the challenge here is that all these costs will be passed down to the consumer, further making the cost of insurance even more.
And on matters access to credit, which is a critical issue, especially now in an economy that needs revitalization, credit becomes very critical. And we've seen for the longest time, especially majority of, I know private sector credit has slightly improved, but majority of micro and small businesses are very risky, that we've seen banks in a way prefer to put their money with government securities instead of the risky side of lending it out to these businesses. So in this finance bill, we're seeing the duality where the government has introduced actually raising the excise duty on financial transactions, that is actually VAT financial transactions. And on the other side, also we are seeing they are taxing, withholding tax on government bonds, which in a way, majority of these are held by our financial institutions in the company. This duality, first of all, how do you think it will impact credit and financial transaction aspect in the private sector?
Thank you, Lou. And just to start with the point on infrastructure bonds, on withholding tax on those infrastructure bonds, IFBs. Now, as you rightly put it at the start of this conversation, at the Kenya National Chamber of Commerce, majority, actually 80% of our membership is medium, small, and micro enterprises. And for the longest time, we've had this challenge where the government is crowding out small businesses when it comes to access to financing, particularly with financial institutions, mainly banks. Now, for us as the Chamber of Commerce, if there is a way in which we could discourage banks from lending to government and instead lend to small businesses and MSMEs, then we would welcome that any day, any time. But even speaking to the other side of the points that you've mentioned, charging VAT, which was previously exempted on banking services, as well as increasing the excise tax on mobile transactions from 15% to 20%, actually increases the prices or the cost of financial services. And we've done the numbers at the Chamber of Commerce, and you realize that the number of Kenyans who are excluded from financial services for the longest time, since 2006, when the central bank started tracking it, was actually decreasing, this population that is excluded from financial services. But then since 2021, for the first time in 2021, it actually increased from 11% to 11.6%. Now, introduction of these taxes are going to make the cost of financial services unaffordable to many Kenyans. And we actually project that by 2027, if these taxes are put in play, and we hope that they don't, the number of the population, the size of Kenyans excluded from financial services is going to increase to about 13% of the total population. And another concern for us as the private sector on these financial services taxes is that it actually doesn't take into consideration the context that we are in as far as capital markets are concerned. And the context that we are in is that of high interest regime, where banks are lending at over 20%. So is this then the right time to increase taxes on financial services? Because this will further raise the cost of financial services, making them inaccessible to many Kenyans.
Okay. This issue of withholding tax, we've even seen there is a proposition to introduce taxing royalties, which is very interesting, and they say to include a payment made as consideration for the use or the right to use any software, proprietary or off the shelf, whether in the form of license, development, training, and maintenance and support fees, and includes the distribution of software. And also there is the whole issue of digital service tax, which has been rebranded in this finance bill 2024. We are talking about an economy that one of the recovery parts is the digital superhighway as one of the tenets to turn things around. But also you see some of the propositions within the finance bill that are not very pro businesses going digital. Talk to me about that duality and that tension. Is it that the government is saying one thing, we are supporting digitization of businesses, but failing to sort of incentivize businesses operating in the digital world and running digital businesses?
Thank you, Mayor. And just to start with the item on digital tax being changed, this actually reflects to the concern on the predictability of our tax regime. Because if you look at digital service tax, DST, it came into effect on the 1st of January in 2021. So it's been about 40 months, give or take, of the implementation of this particular tax, which in private sector terms and in investment terms, it's actually still short term, maybe closer to the medium term. So the name has not only changed, but the percentage charged has also changed because it's from 1.5%, and if you make the calculations on the effective rate, it's been pushed now to proposing 6%. So that is about 300% hike, which is quite steep for any tax proposal. So then investors who've made an investment in 2021, in a span of 3 years, the name of the tax has not only changed, but also the rate. So then that tends to put off investors and deters investors from making an investment into such an economy because they need the predictability and stability of the tax regime. Overall, the taxes on digital services are not taking into consideration also the context that we are in, because if Kenya is to become the leader, we know that we are leaders in some parts of technology, but if we are to compete globally, then we have to allow businesses, at least MSMEs in the technology sector, to really grow and to have their prices be competitive compared to markets like India, markets like China, markets like Nigeria, which have had a great leap, South Korea when it comes to technological services. So we should allow this subsector of the economy to grow fast and allow it time and have advantage over other economies before we can go in and put taxes and reap the benefits thereof.
Okay. And now touching on this issue of balance of trade, because I'm pretty sure within your value chain, a lot of businesses depend on import. Some are in the export business. And I know as Chamber of Commerce, working closely with even the Kenya Association of Manufacturers, the narrative has always been, how can we be able to, first of all, export more than we can import in terms of tapping into the export market, but also the aspect of value addition. And I think that has a ripple effect on the local economy if it is something that we can focus on properly. Looking at this document, is it reflective, and even just walking a few steps back into the budget policy statement, do you think there is a level of intentionality by the government to sort of boost that aspect of balance of trade, exporting more, and secondly, also value addition of our products?
Thank you, Mayor. When you look at the steps by the current government of Kenya, you realize that there is a mismatch between the aspiration and the action. So there is an aspiration to increase exports, and if you could see the volatility that the Kenyan shilling has experienced, one of the remedies for that is to increase our exports so that the shilling could stabilize and become stronger. But then if you look at the finance bill proposal 2024, case in point, the application of VAT services, VAT on banking services, and one of the services being FX transaction, Forex transactions. And Forex is critical in international trade during exports and imports. So when you apply VAT on FX transactions, then you're discouraging international trade and you're discouraging exports. So you're making exports, more expensive and sort of like discouraging it. If you also look at outside the finance bill, last week, the Agriculture and Food Authority, AFA, issued a statement that come the 1st of July 2024, they're going to put an export levy on food crops, particularly cereal, legumes, as well as roots and tubers. Now, what does this do? It makes food crops from Kenya uncompetitive compared to those in the global markets. So it does discourage the export of food products from Kenya. Now, that is the action of the government, but then the intention is supporting the other side. At the Chamber of Commerce, we do offer the certificate of origin that certifies that indeed this product is coming from Kenya. And we are in touch a lot with exporters. And speaking to them, it is consistent that increase in charging VAT on Forex transactions is going to affect exports, as well as the directive from AFA to have an export levy on food crops is going to discourage exports. So this is going to make our shilling less and less strong, even as we hope and